Welcome back to Smart Stock Sam, the channel where we follow the data, call the setups before they happen, and let the tape prove us right. And today, I want to open with something that proves trades backed by data never let you down. We had such one recently, and it played out almost to the exact penny. A few weeks ago, right here on this channel, we mapped out a precise technical battleground for AMC Entertainment. We identified the exact resistance ceiling, the exact support floor, and the exact breakout level that would confirm the thesis. And then the market went ahead and did exactly that, closing within a single penny of our stated target in one explosive session. Today, we are going to break down every single layer of this setup because the move that already happened is only the opening chapter. The real question, the one that will define whether you profit from this or simply watch from the sidelines, is what comes next. We are going to walk through the institutional footprints, the insider conviction, the box office recovery, the debt reality, and then we will pull back the curtain on one hidden options market metric that is quietly dictating exactly where this stock goes in the week ahead. Stay with me all the way to the end, because missing that single data point could be the difference between riding this momentum and getting caught on the wrong side of it. This is AMC Entertainment. The breakout is confirmed, and $2 is the ultimate target. Let us start with the moment everything changed, the tape on Friday, May 29th, 2026. On that single session, AMC surged 9.49% to close at $1.73. Now I want you to pause on that number for a second, because percentage moves in isolation can be deceiving. What makes this session genuinely remarkable is what was happening underneath the price. Over 42 million shares changed hands in a single day. That is not retail traders clicking buy on their phones during their lunch break. That is institutional-level accumulation, organized, deliberate, and directional. When you see that kind of volume flooding into a $1.73 stock, you are watching the early stages of a very serious narrative shift. Wall Street had been treating AMC as a distressed asset for well over a year, a company fighting simply to keep its doors open, rolling over debt, burning cash, surviving quarter to quarter. But the data from Friday told a completely different story. We are watching AMC actively transition from a survival story into a high-momentum turnaround play, and the volume confirms every bit of it. This surge was powered by three distinct and simultaneous catalysts: a confirmed technical breakout, decisive insider conviction, and major institutional accumulation. And here is what makes this setup particularly powerful. All three arrived at exactly the same time. Now, if you have been following Smart Stock Sam through our previous AMC updates, none of this explosive price action should have surprised you, because we told you exactly this was coming. In our analysis, published on May 21st, we meticulously mapped out the battleground for this stock. We established that $1.50 was the critical structural base that had to hold, and that $1.60 was the immediate ceiling the bulls needed to breach. And look at what the market did. Between May 21st and May 28th, the price consolidated perfectly inside that tight channel, coiling between $1.51 and $1.59 for 7 consecutive days. It was a spring being compressed under enormous pressure. On Thursday, May 28th, AMC closed at $1.58 on a quiet 19.2 million shares, the calm before the storm. Then on Friday, the pressure cooker exploded. The stock completely shattered that $1.60 ceiling, hitting an intraday high of $1.79. That is exactly one single penny away from our official $1.80 breakout target, 1 penny. We successfully front-ran Wall Street on this entire setup, and the accuracy of that call is not luck. It is the direct result of reading the data correctly and having the discipline to trust it when others doubted. But here is a question worth sitting with for a moment. Technical setups do not trigger themselves. They need a spark. And in AMC's case, that spark came from the very top of the company. On May 19, 2026, CEO Adam Aron walked into the open market and personally purchased 250,000 shares at an average price of $1.38 per share. Do the math. That is approximately $344,000 of his own personal capital placed directly into this stock. I want to be very precise about why this matters so much, because not all insider buying carries equal weight. This was not a scheduled executive stock grant. This was not options vesting on a predetermined company timeline. This was an open market purchase, cash out of pocket, made by a man who has access to every internal metric, every projection, every debt covenant, and every operational forecast that you and I will never see from the outside. And here is the most telling detail of all. This stands as the only insider buy on AMC's books in the past 12 months. In the finance world, there is an old saying that insiders sell for a million different reasons: buying a house, paying a tax bill, diversifying a portfolio. But insiders only ever buy for one reason. They genuinely believe the price is going higher. That $344,000 transaction served as the fundamental ignition for the roughly 15% weekly surge we are now tracking. And Aron's conviction is not blind faith. It is anchored in something very real. The ticket counters are filling back up. Over the recent United States Memorial Day weekend, AMC drew more than 5 million moviegoers globally. That represents their absolute best Thursday to Monday domestic attendance figure for the entire calendar year. The surge was headlined by Disney's The Mandalorian and Grogu, which pulled in roughly $100 million domestically in its opening weekend, alongside a stunning 30% week-over-week box office increase for the film Obsession. But here is the detail that most people overlook when they analyze theater companies. The real profit engine is not the ticket. The ticket gets you through the door. The popcorn, the drinks, the hot food, that is where the margin actually lives. AMC is aggressively engineering that side of the business right now. They have rolled out their feature fare hot food menu to over 400 theater locations, specifically to drive up per-patron spending. And this June, they are launching the Arena One live concert series across more than 300 theaters simultaneously. A high-margin, alternative revenue stream that literally turns a movie screen into a live event venue on nights when no blockbuster is scheduled. These are not cosmetic gimmicks. These are structurally meaningful moves designed to permanently widen the margin profile of a business the market has been dramatically undervaluing. Now here is where I have to be completely straight with you, because Smart Stock Sam is built on honest analysis, not hype. The operational story is genuinely improving, but the balance sheet is still carrying enormous weight, and you need to understand it fully before you risk a single dollar. On the positive side, AMC's first quarter revenue surpassed $1 billion, a meaningful jump from $862.5 million in the same quarter a year prior. Even more encouragingly, they posted a positive adjusted EBITDA of $38.3 million, proving the core operations can actually generate cash when stripped of financing costs. But the other side of that ledger is brutal. AMC is carrying $3.96 billion in corporate debt. Because of the interest burden on that debt, they still posted a first quarter net loss of $117.1 million and burned through $174.7 million in cash during the quarter alone. That is the ticking clock hanging over this entire story. AMC is in a race, a very real, very consequential race, to accelerate those high-margin concession and concert revenues fast enough to outpace quarterly cash burn before debt maturities force their hand. That risk is real, it is serious, and any honest analysis has to acknowledge it directly. Yet despite that heavy and very real debt load, the most sophisticated institutional investors in the world are quietly and aggressively building positions in this name. Pentwater Capital recently constructed a 9.99% ownership stake in AMC, holding over 63.64 million shares. Now ask yourself, why 9.99 and not 10? because 10% is the hard regulatory threshold where strict primary insider reporting and trading restrictions kick in under SEC rules. Pentwater literally maxed out their legal ownership limit without crossing into insider territory. That is not carelessness, that is surgical precision at scale. Simultaneously, Discovery Capital Management boosted its stake by over 41% and now holds an 8.00% position with 46.38 million shares. Layer in additional institutional holders, including Vanguard, State Street, and Renaissance Technologies, and the picture becomes unmistakable. These are not momentum chasers looking for a quick day trade. These are long-term, high-conviction allocators positioning for a fundamental re-rating of this company from distressed asset to genuine recovery story. And that institutional confidence is now forcing Wall Street sell-side analysts to rewrite their scorecards. AMC is currently trading at $1.73. Roth MKM recently raised their price target to $1.50. Acknowledging, at minimum, that the structural floor is holding. Benchmark officially upgraded the stock to a buy rating with a $2.50 price target. And leading the entire analyst pack is Wedbush, who reiterated an outperform rating with a street-high $3 price target. Wedbush's thesis is particularly compelling because they are projecting that AMC's EBITDA margins will expand to somewhere between 13 and 16%, a structural improvement that fundamentally changes the debt management equation. If AMC achieves a $3 valuation, that represents nearly 75% upside from where it trades right now, 75%. That number deserves to be said twice. From a purely technical standpoint, AMC is flashing a consensus strong buy across every major indicator we track here at Smart Stock Sam. The stock has successfully completed a massive structural shift, converting former resistance levels into new support floors. Price is trading cleanly above the 50-day simple moving average at $1.56 and above the critically important 200-day simple moving average at $1.53. That 200-day cross matters enormously. When a stock decisively clears it, algorithmic trading systems across the entire market automatically flip from net short to net long, triggering computerized buying programs at scale without any human discretion involved. Momentum is meanwhile violently accelerating. The 14-day relative strength index is sitting at 73.02, pushing into overbought territory. The MACD reads 0.049, and the rate of change indicator is registering 9.494. Every single metric we track is pointed in precisely the same direction. Now let us go under the hood at the systemic pressure mechanics, because this is where things get genuinely explosive. Right now, 63.29 million shares are held short, comprising roughly 9.13% of the total float. The days to cover ratio is 2.48, meaning approximately 2.5 full trading days would be required for short sellers to completely exit their positions. But the truly combustible detail is the off-exchange activity. Dark pool trading, institutional repositioning happening away from the public lit markets, is currently constituting anywhere from 22 to 43% of daily volume. Major institutions are moving in ways they specifically do not want the broader market to observe in real time. And simultaneously, borrow availability is evaporating. There are currently only 2.1 million to 2.9 million shares actually available to borrow for new short positions. The walls are closing in on every short seller still holding this name. And that brings us to the hidden metric I promised you, the options chain. This is where the week ahead becomes truly fascinating. At the $1.50 strike price, there are 58,148 open call contracts providing structural support. That is your concrete floor. Looking up the chain, we encounter the final boss, the $2 strike price, where a staggering 127,239 open call contracts are stacked. This creates a gravitational call wall, As AMC approaches $2, market makers who sold those contracts are obligated to dynamically hedge their exposure by purchasing the underlying stock. This mechanic is a gamma squeeze. The approach forces buying, which pushes price higher, which forces more hedging, which generates more buying, a self-reinforcing loop. With implied volatility running above 130%, the options market is already pricing in enormous near-term movement. The options chain is not just showing you where resistance lives, it is showing you the exact mechanism by which that resistance could be violently shattered. So how do you actually trade this? Your approach must match your time frame. Short-term traders need three things on their radar simultaneously. First, monitor intraday short borrow availability continuously. If that number approaches zero, expect explosive upside movement fast. Second, watch the options flow battle specifically around the $1.79 to $2 zone, where gamma pressure concentrates most intensely. Third, track the early June box office results, particularly the June 5th releases of Scary Movie and Masters of the Universe, which represent fresh, attendance-driven catalysts for the trade. If you are a long-term investor, your discipline is entirely different. Block out the daily noise. Focus exclusively on free cash flow trajectory, debt refinancing progress, and per-patron concession spending growth quarter over quarter, because AMC absolutely needs those numbers, moving to close the gap on $174.7 million of quarterly cash burn. Here is the precise blueprint for the week of June 1st through June 5th, 2026. This setup is officially classified as a speculative bullish breakout. Optimal entry zone sits between $1.60 and $1.65 on any minor retracement that confirms the former resistance ceiling has flipped to solid support. Risk management is non-negotiable. Primary support sits at $1.60. The critical base zone is between $1.50 and $1.53, a powerful convergence of the 200-day simple moving average and that massive 58,000 contract call wall. But if we see a daily closing candle below $1.50, the bullish thesis is invalidated. You cut the position immediately. No hesitation, no rationalizing. That is the line in the sand. To the upside, here is your step-by-step roadmap. First resistance sits between $1.75 and $1.79, the Friday pivot high zone. Clear that with conviction, and we reach target 1 at $1.80, the confirmed breakout threshold we targeted weeks ago. The ultimate destination is target 2 at $2 even, the final boss. If that level breaks on strong volume, the ceiling comes off entirely, opening the door toward the Analyst consensus targets of $2.50 to $3. That is the full ladder from base to breakout to the big move. Before I get to my final thoughts, there is an important message for everyone watching. Everything discussed in this video is for informational and educational purposes only. Nothing here constitutes personalized financial advice, investment recommendations, or a solicitation to buy or sell any security. Stock trading and investing involve significant risk, including the possible loss of your entire invested principal. Always conduct your own independent research and consult a licensed financial advisor before making any investment decisions. Past performance, including the accuracy of prior price targets discussed on this channel, does not guarantee future results. AMC Entertainment carries substantial balance sheet risk, including nearly $4 billion in corporate debt, and this remains a speculative, high-volatility situation. Never risk capital you cannot afford to lose. The bottom line is this: AMC has real mechanical velocity on its side right now. That momentum is fully backed by maximum allowable institutional positioning, a rare and unhedged executive open market purchase, stabilizing box office fundamentals, and a technical structure that has now confirmed a legitimate breakout with precision. The data is clear. The shorts are cornered. The options chain has set the stage, and $2 is the wall that everything is pointing toward. Keep your risk managed. Trust the levels. Watch the data. Stay disciplined. Because in markets, discipline is what separates the investors who actually profit from the ones who simply watch it happen from the sidelines. Now here is my genuine question for you. And I want to hear your honest thinking on this. Given that AMC is carrying nearly $4 billion in debt, yet simultaneously posting its best attendance numbers of the year and attracting maximum allowable institutional stakes from multiple sophisticated funds at the same time, do you actually believe the business fundamentals can outrun the balance sheet before the debt comes due? Or does the clock simply run out first? Drop your real answer in the comments right now. I read every single one, and the most insightful responses shape the next deep dive analysis. If this breakdown gave you clarity on a setup the mainstream financial media completely missed, hit that like button right now. It directly helps more people discover Smart Stock Sam and become part of this community. If you are not yet subscribed, tap subscribe and ring that notification bell so you are first in line when the next high conviction setup drops. And if you want to directly support the research, the time, and the work that goes into every one of these deep dives, YouTube's Super Thanks feature is right below this video. Every single contribution goes straight back into making this channel better for every one of you. I will see you in the next one.